The stock market can feel like a complex puzzle, but with the right strategies, you can navigate its twists and turns. Options trading is one such tool. It allows investors to manage risk and enhance their returns. This guide will simplify two popular options strategies: covered calls and covered puts. Don't worry, we'll explain everything in plain English. By the end, you'll have the knowledge to decide if these strategies fit your investment goals. Options trading might seem intimidating at first. However, covered calls and covered puts are relatively straightforward. These strategies are particularly useful for investors who already own stocks. They provide ways to generate additional income and protect your portfolio. This guide will equip you with the knowledge to understand covered calls and puts. We will explore their mechanics, potential benefits, and inherent risks. By using practical examples, you'll gain a clear understanding of how these strategies work in the Indian stock market. So let's dive in and demystify the world of covered calls and puts. Imagine you own shares of a company you believe in. You're optimistic about its long-term prospects, but you wouldn't mind earning some extra income from these shares. This is where covered calls come in. A covered call is an options strategy that allows you to generate income. You do this by selling call options on stocks you already own. Here's how it works. When you sell a call option, you are giving the buyer the right, but not the obligation, to buy your shares at a predetermined price, the strike price, before a specific date, the expiration date. In return, you receive a premium. Think of it as renting out your stocks for a fee. Covered calls are best used when you expect the underlying stock price to remain relatively stable or increase slightly. If the stock price stays below the strike price, you keep the premium. You also keep your shares. If the price rises above the strike price, the buyer may exercise their option. You will then have to sell your shares at the agreed-upon price. Let's say you own 100 shares of Reliance Industries. The stock is currently trading at 2,500 rupees per share. You're cautiously optimistic about the stock's performance. You believe it will remain around this price level in the near future. You decide to sell one call option contract. Each contract typically represents 100 shares. You choose a strike price of 2,600 rupees with an expiration date 1 month out. The premium you receive is 50 rupees per share. In this scenario, you immediately receive a premium of 5,000 rupees, which is 100 shares times 50 rupees. If the Reliance Industries stock price remains below 2,600 rupees by the expiration date, the option expires worthless. You keep the premium and your 100 shares. If the stock price rises above 2,600 rupees, the option buyer may exercise their right to buy your shares at that price. Understanding the potential profit and loss scenarios is crucial for any option strategy. Let's break down the payout structure for covered calls. Maximum profit. Your maximum profit is limited to the premium received when you sold the call option. In our Reliance Industries example, your maximum profit is 5,000 rupees, regardless of how high the stock price goes. Maximum loss. Theoretically, your maximum loss is unlimited in a covered call. This is because the stock price can rise indefinitely. However, your loss is limited by the fact that you own the underlying shares. Break-even point. The break-even point is the stock price at which you neither make nor lose money. It is calculated by adding the premium received to the strike price. In our example, the break-even point is 2,650 rupees, which is 2,600 rupees plus 50 rupees. It's important to remember that options trading involves risk. While covered calls can generate income, it's crucial to carefully consider your risk tolerance and investment goals. Section 5. Covered call risks and rewards. Weighing the pros and cons. Covered calls, like all investment strategies, come with their own set of risks and rewards. Let's assess the pros and cons. Advantages. Income generation. This is the primary advantage of covered calls. You earn premium income by selling call options. This income can supplement your portfolio returns or offset potential losses. Limited downside protection. Since you own the underlying stock, your losses are cushioned if the stock price falls. Suitable for stable markets. Covered calls perform well in sideways or slightly bullish markets where large price swings are not expected. Disadvantages. Limited profit potential. Your maximum profit is capped at the premium received. You miss out on potential gains if the stock price surges significantly. Potential for forced sale. If the stock price exceeds the strike price, you may be forced to sell your shares at a price lower than the market price. Opportunity cost. Holding onto the stock for the covered call limits your ability to capitalize on other investment opportunities. Before implementing a covered call strategy, it's vital to carefully evaluate your risk tolerance, investment horizon, and market outlook. Section 6. Covered puts. Profiting from market declines with a safety net. Covered puts are the inverse of covered calls. This strategy allows you to profit from a decline in the stock price while providing a degree of downside protection. Essentially, you are selling the right for someone else to sell you shares of a stock at a specific price. To execute a covered put, you need to own the underlying stock or have a cash position equivalent to the value of the shares represented by the put option. This cash reserve acts as collateral and ensures you can buy the shares if the put option is exercised. Covered puts are most effective when you anticipate a moderate decline or stagnation in the stock price. If the stock price remains above the strike price, you keep the premium received. However, if the price falls below the strike price, you may be obligated to buy the shares at the predetermined price. Section 7. Covered put example. Capitalizing on potential downside with Infosys. Let's imagine you have a bearish outlook on Infosys. You believe the stock price, currently trading at 1,500 rupees, might drop in the coming weeks. You decide to sell one covered put option contract with a strike price of 1,450 rupees and an expiration date 1 month out. The premium you receive for selling this put option is 30 rupees per share. By selling this covered put, you immediately earn a premium of 3,000 rupees. 100 shares times 30 rupees. If the Infosys stock price remains above 1,450 rupees by the expiration date, you keep the premium. The option expires worthless. If the stock price drops below 1,450 rupees, the put buyer might exercise their option. You would then be obligated to buy 100 shares of Infosys at 1,450 rupees per share. Section 8. Covered put payouts. Deciphering the potential outcomes. Similar to covered calls, understanding the potential profit and loss scenarios is essential for covered puts. Maximum profit. Your maximum profit in a covered put is limited to the premium received when you sold the option. Maximum loss. The maximum loss occurs if the stock price falls to zero. In this scenario, you would be obligated to buy the shares at the strike price, resulting in a significant loss. Break-even point. The break-even point is determined by subtracting the premium received from the strike price. In our Infosys example, the break-even point is 1,420 rupees, 1,450 rupees minus 30 rupees. Keep in mind that options trading involves inherent risk. It's important to carefully assess your risk appetite and investment objectives before implementing a covered put strategy.